Duncan, this week, my little guy, Logan, turned 3 years old. He got some checks, and I deposited them into his liftoff account. You know, and you know what? I also sprinkled a little bit on top. I'm his dad, right? I got him a birthday present.
You didn't take a cut.
I did not. Ooh. Not only did I not take a cut, I even sprinkled in some on top of my regular scheduled monthly payments. He'll thank me later. So if you want to invest alongside Logan, alongside Kobe, alongside myself, go to liftoffinvest.com.
Compounded Friends, episode
61.
What?
61.
61. How did we do that? Is everyone excited to be here?
Isn't there a Roger Maris
Very confident in my
thing we should be talking about? Number 61
That
here?
movie.
61.
And that's coming, isn't it?
This could be the new record. The new record for podcasts here. Next week, though, I think we'll break the record at 62. We'll see what happens. Hey, Belski's here. Brian, let me give you an official introduction. I'm so excited that you're here. We planned this a long time ago, and I knew it was going to be a great show, and the timing really couldn't be better. So Brian is the chief investment strategist and leader of the investment strategy group for BMO. Brian has more than 33 years, I've recently learned. I'm hearing in my ear. 30 years of experience in the investment industry, previously holding senior roles at Oppenheimer, Merrill Lynch, Piper Jaffray, among others. Other than BMO, what was your favorite firm to work at, or what was the best culture?
Merrill Lynch.
Why?
For sure.
That's where you really became known, I feel like, right? Your stuff for Merrill?
It was actually Piper.
Oh, it was okay. Piper.
Because of Mark Haynes at CNBC, and I'd love to tell you the story.
Yeah,
But
tell it.
Tell it now.
so,
We love Mark Haynes.
oh my gosh, this man. So if you remember what happened 9/11, the markets opened up that following Monday, right?
Never forget.
And if you remember,
So it closed on a Tuesday. 9/11 was a Tuesday.
was it Tuesday?
They spent the whole week somehow getting that shit ready,
Yep.
and were able to open it Monday.
Yep.
And that was like a moral victory like none other at that time.
I mean, it was such a talk about perspective. I mean, let's go back. I was supposed to be in the Tower 2 that day. My travel schedule changed, and I actually last minute, and I was still signed out to be in New York City. And back in those days, you didn't have all this stuff, right? All the electronics. So, I was in Milwaukee, and thankfully, I had a car, or a truck actually, and I drove back to Minneapolis where Piper Jaffray was. I show up on this all-hands-on-deck meeting on Wednesday, tried to find what the hell's going on, right? Tried to figure this out. And I walk in, and people looked at me like I was like a ghost. Like, you're supposed to be in New York. They couldn't get you.
They thought you were gone.
Yeah.
Yeah.
Wow. So anyway, so the following Monday, you remember President Bush came out and said, we're going to patriotic buying, support the stock market. Do you remember that kind of stuff?
It didn't work. But
Didn't work, right? So but the market opened up, and I had just been talking to a few hedge funds, and like, sell, like get out, right? And I get on CNBC.
Canadian.
Yeah. No, well, I'm an American for the record. I was born and raised in Minnesota. I do have the accent, you know. But so I get on CNBC, and Martha McCallum was on CNBC at the time, and she did the show right after opening bell or something right after Squawk Box, and she's like, Brian, I was on camera at Piper. Brian, how come the market's going down? Who's selling? And I said, Martha, I said, even if I knew, I wouldn't tell you.
Yeah, it was David Rosenberg.
No, it's actually a couple of hedge funds that are no longer around. But anyway, so Haynes saw that, and he said, I want to get this Belski kid on. Okay. So the next day, you know, even back then, you couldn't be on CNBC 2 days in a row. So next day, I'm on Squawk Box. Same thing, and he's grilling me. And at the end of the interview...
This is Mark?
Mark Haynes, yeah, it was amazing. It was so cool. And so I'm on with Haynes, and toward the end of the interview, he goes, I really like this Belski kid. We should get him on more.
Okay.
The next month, I'm starting to co-host Squawk Box.
Look at you. How old were you?
I was 12.
You know, I can't get on Squawk Box now. I can't cross over.
Either can I.
Yeah, I'm a halftime report guy. That's it.
I know. There's a story behind that. But anyway, so I was 35. I was 35.
Okay.
Yeah, 35. And so
what were you saying? Like that? Like what is there to really? This has nothing to do with investment strategy.
It had nothing to do with strategy. I'm like, you know, we were in a period there. Remember, we were kind of double dip recession. It was.
We were in a shitty bear market
bear market
a year in.
And he was like giving me shit because I was underweight on tech, and like, how can you be a piper and be an underweight tech?
Yeah.
And I'm like, come on, man. I mean, I don't get paid by investment banking. I mean, I'm told to tell people what to do, not what they want to hear. And it was not popular. And I'm telling people, talking about dividend growth and all the same stuff I've been talking about for a long, long time. And he really, really liked that I was just direct and no bullshit.
Because that's what he was like.
Yeah, he was great, man. And every month from there, so from September 2001 to then he left the show in 2005. I was still kind of in the schedule on co-hosting Squawk Box. And actually, I was co-hosting Squawk Box the day that Bear Stearns went away.
Oh, boy.
So I've just been blessed and fortunate.
You know that was St. Patrick's Day? Do you remember that? Mm-hmm. So not a lot of people realize that. They went under on March 17th of 08.
Okay, do you remember the weekend before that, though? Because I
sure do.
It was an ice storm in Philly, and I was at Delaware Funds, and we got trapped there. And the guy that ran Delaware Funds was an Irish guy, so he's got a keg on. And it's the first time and only time in my career that I had half a buzz on when we were doing an institutional meeting because we were drinking beer. And so I was living in Ridgewood, New Jersey at the time, and the SUV driver said, "We got to leave now." And we went to the Philly train station and couldn't get on a train. So he said, "I'm driving you back. Let's get a 12-pack of beer and a pizza." And he and I drank beer and ate pizza on the way back to Ridgewood. But anyway, CNBC and Mark Haynes, such an amazing man and great to me for all those years. And then I was one of his first guests on Squawk on the Street, and he was just amazing. So
right, then they created Squawk on the Street, Squawk SVU, all the Squawks. Squawk Alley is another one now.
Yeah.
Okay. Mark was the man. And if you go to the New York Stock Exchange to this day,
there's still a picture.
The stairwell to get up to the catwalk where they do your makeup and mic you up, there's a photo of Mark framed and like a plaque under it, and I hope that's there for the next 200 years.
Yeah.
So, well, listen, we're really excited to have you today, and I said the timing is perfect. So, from my perspective, 20-something years doing this, I can't ever remember a time where I personally felt it was so flip a coin between like recession, bear market, or nope, you know what? It's fine. We're about to lift right out of this. I really don't have a strong view of which way it could go. I could be so easily convinced in either direction. And most of the people that we talk to are absolutely convinced this is on the verge of getting much worse. You are the opposite. You are steadfastly bullish. So I'm so excited to give our audience the other side of the coin. And I know you do so with a lot of data and a lot of experience. So thank you so much for coming in.
Thank you.
We really appreciate it.
Thank you.
Your new note is called "Make No Mistake, It Has Been a Battle to Remain Bullish," or "The Battle to Remain Bullish." What's the story behind what prompted you to write the note, other than you knew you were coming here?
It's all about the podcast, right?
Okay,
I did this for this. I mean, come on.
I figured,
let's be clear. No, it's entitled "Hold the Line," and I wanted to talk about the battle to remain bullish, and I thought about kind of pop culture. A lot of times when I do public speaking, I kind of warned your producer before, I'm kind of half Deadpool, half Jesus Christ, because I'll throw
good mix.
Exactly.
Good mix.
Two kind of cool dudes. I'll throw out some pop culture and swear a little bit, but then I'll also talk about scripture, and but I'm on vacation like the majority of the Western world. I'm in the second half of the vacation. I'm getting emails from institutional clients because my principal job, aside from managing money, and I hope we get a chance to talk about that, is to talk to institutional investors around the world. And these people are emailing me like, "Belski, you were wrong. Why were you saying this? You know, June, July rally was a sucker rally, blah, blah, blah." And I'm like, okay, I can't handle it anymore. I got to write something.
Yeah.
So I took out
you got inspired.
I got inspired. And I took out my iPhone machine and on the notes thing, and I cranked out this report. And then Tuesday we kind of edited it and put some cool charts. And people that work for me are much
See, if you were a blogger, you would have just smashed publish and then tweeted it, and then
no, I can't do that.
Yeah. No, I know. It's better this way. Yeah. So you had some time to think about what you wrote, and you still believed it.
Yeah, good luck with the career, Belski, working for a bank.
That's right.
With the compliance. But I really thought that it really kind of came back to my core thought, Josh, that people really lack perspective. And that August never matter.
So I heard you. By the way, I heard you on CNBC yesterday. I was away, but I was watching, and I heard you make that point, and that was like really intriguing to me. Maybe it doesn't matter in that it's not a pivotal month, right? But like it matters if people are making a lot of money or losing a lot of money. It definitely matters to sentiment. Or do I have that wrong?
Sentiment in terms of feeling for kind of setting up the fall, but we looked at it from an analytical perspective. We said, okay, so if you look at August historically and you correlate that to year-end performance, the relationship is spurious, not to bore anybody with respect to math.
What's the R squared on that bad boy?
I don't know.
Don't worry about it.
Now you're going too deep.
Michael, crank it out.
But it does matter for September and October. And the whole part that I was coming at is that people are giving me shit on my vacation because the market's rolling over in August. Nobody was working. Well, the cat's away, the mice will play.
Every year.
Every year. I remember I was at Merrill and we got this in August of 2007. They said, cancel your vacations because the shit's hitting the fan. It's, really? It happens every August. I mean, what's
now you know August doesn't really matter on Wall Street.
No.
The CEO of Goldman Sachs spends the month DJing in the Hamptons. That's how you know it doesn't really matter.
So I use this pop culture thing in the report. Early in the report, I talked about Hold the Line with respect to Saving Private Ryan and Hacksaw Ridge and The Patriot. Have you ever seen those movies?
And Braveheart.
Braveheart.
Yeah, that's a big one. Hold the line.
Hold the line.
Where's the line?
3,400.
I'd say 3780. Okay.
32. No, anyway. 12, 13 volt, whatever it takes. Anyway, so I use this pop culture reference from 1993, the album from Counting Crows, August and Everything After, right?
Great record.
So it really happens about everything after. And this year more than ever, and here's why it's this year more than ever. I still believe that we're in the early stages of transitioning back to normalcy. What the hell does that mean? It means that we've all heard in financial markets, those that work for big banks got to be in the office 3 days a week. That's going to turn into 4, and that's going to turn into 5. We're getting back into living again. That's really, really good for everybody in terms of the economy, for cities. We're going out to lunch.
For
we're
marriages.
spending money.
Yeah,
exactly. But more this year than ever. Keep in mind that September and October, because the inflation data is coming out, because of the Fed, we already know all that, right? But what we're missing is that this is conference season. We have not had a proper conference season since 2019 investor conference, whether that's the JP Morgan conference in San Francisco or the Code conference.
They've been bullshit virtual. Nobody actually pays attention.
Yeah, we're not engaged. Everyone's excited. We're together. We're humans. We need to be together. So it's the stage to get back into what's real. And I think what I think is going to end up happening is as we start to feel like things are getting real again, we're going to understand is we're going to get it like, it's not the end of the world. We're actually in a pretty good market here. We got great companies. The market did its job by doing its correction. You don't have to apply the rule of thumb that now earnings have to go down 20% and unemployment has to double. We talk about that in the report. I think it's not going to happen.
This is you. Quote, we simply believe that most investors are not, all caps, are not positioned for, all caps, any good news and are, all caps, ignoring did my daughter teach you how to write? Ignoring the signposts that we believe have been developing and which will lead to an end of the year melt up in stock prices. To use one last war analogy, time for investors to get out of the foxholes and bunkers. What's done is done. Stop lingering in the smoke and pillage behind you. Hold the line and move forward. Shit, I hope you're right. I would love a year-end melt up. Like, I really would. And I think, though, the problem for people is that there hasn't been enough damage on the earnings side. We had communication services, 27% derating in multiple. Tech, 25%. Financials, 20%. Oil and gas, 22%. We've had the multiple compression everywhere except utilities, like every sector. The earnings estimates have not come down almost at all. In fact, there should be up 11% this year. So I think from most people's perspective, the reason why they're remaining bearish or they're not as bullish as you think they should be, they just feel like, of course, that's coming next. And you're arguing that it doesn't have to. It
doesn't have to because I think one of my biggest problems, what I've been fighting for the majority of my 33-year career is that I think people have become too formulaic, too academic, too by the book. We're so afraid to be wrong. We don't want to be right. I'm going to use an old reference because I'm an old guy. Remember Lotus 1, 2, 3 and the backslash when you're building spreadsheets? Really going deep here on this. But your life doesn't have to add up to double underline. I think investing is like life and life is like investing. And so I think the more formulaic we are, ultimately when shit goes sideways, we said, the formula told me to buy it, so that's why. We've forgotten how to pick stocks. But on the earnings side, what I think is really interesting and important, I think that there's been a secular, not structural, but secular trend on companies sandbagging, on companies under-promising and over-delivering. And I think it was out of result of the tech wreck. This is where the perspective comes. If you look at the late 1990s in 2000 and then the buy the dip craze that started 2001, analysts were rock stars. Whatever the analyst said, that's the number, right? And they lost all credibility after that. And then quantitative analysts really took over in terms of screening. I'm going to prove what the numbers are because I'm going to look at all consensus numbers. We've forgotten how to pick stocks. We've forgotten how to look at stories. And so I think that's really put a psyche on the market not to believe in any of the earnings. Someone asked me a really great question.
You can see, though, it's the gamesmanship. It's like beat by a penny or beat by 2 cents, your stock goes up. Beat by 1 cent, your stock is flat. Hit the number or below, your stock goes down. Yeah. That's not the company's fault. That's not the analyst's fault. That's just what the market has decided that's the game they're going to play. And then we had whisper numbers in the 90s, which were stupid.
Yep.
Because then the whisper number became more important than the real number. The whisper number was made up by a website. It didn't even really exist. So it's kind of like that is the game. It's not – I agree with you. It's stupid, but it's like that's the game that's being played.
So that brings up a great point for right now. Right. So second quarter, companies were rewarded in terms of the rally for not being as bad as everybody thought.
Yes.
Right. So are we going to have the same thing in the third quarter? Right. No one's talking about this. We'll see. And numbers actually have gone up. Like if you look at the growth rate for current year earnings for 2022, they're up 5% since the beginning of the year.
Can I do Steve Weiss? It's all energy. I know, but it's true. But it's true.
It is true, but look at the energy's contribution to earnings growth. If we can have a really big number, you can be like a really big dude, but you're not really contributing anything. You know what I'm saying? Because you're really small, actually. And so, why are you laughing?
That's the story of his life.
So, but tech, think about tech, right? I mean, tech's still the juggernaut. And I think tech is still very, very well positioned in terms of the big tech names. And like Apple came out yesterday, just something phenomenal. I mean, phenomenal. It's just amazing on what they did in terms of no raising prices.
Yeah.
That's leadership, right? But anyway, I think people are going to continue to buy tech and buy the U.S. market just because of the stability of earnings and the high standard deviation of earnings everywhere else. We have low standard deviation earnings here. I mean, just look at what the currencies have done in Europe, and look at Europe as an asset has lost 1,000 basis points of world GDP the last decade. Why the hell would you want to be invested in Europe? Why would you want to be in China given that lost decade of performance there? I think it's Fortress America. I do. Now, it doesn't mean that we're not going to have problems. It doesn't mean that we're still trying to figure out what the hell the number is. But think about the analogy on earnings, right? So stocks went up because earnings weren't as bad. So now let's start talking about inflation. What if we start printing numbers that aren't 8%?
Yeah. Could happen.
It could happen. And then people are like, go. Because going back to why the hell I was writing this report on my vacation is my clients are underperforming. Institutions are underperforming because they sat on their hands in June, July because they didn't believe it because of what you said earlier. We're waiting for the next shoe to drop. We're waiting for earnings to drop, right? So they're waiting. So the FOMO trade hasn't even started yet. The FOMO trade hasn't even started.
It had a 17% rally from the bottom of the market in mid-June until the top in mid-August. Now we fell into a pause. You argue it's because a lot of people are on vacation and who gives a shit. Okay, now it's September, whatever. We really aren't giving much of that rally back. We kind of seem to be stabilizing.
Yeah.
Right?
Why aren't things deteriorating? I think people are getting frustrated that the numbers aren't like getting softer.
So I'm going to come up with another movie.
You're totally right.
But it's true.
Why
aren't things worse?
Yeah. Why won't it melt down already so I can buy?
I'm going to butcher the quote, man. Kevin Spacey in Usual Suspects, right, talks about, and he copied the quote from somebody else, but the devil's greatest trick is to make everybody believe that he wasn't real, right? Everybody's convinced, man, the world's coming to an end. What if it doesn't? right?
Yeah.
That's the case. Like I was in.
You wrote about this. You said we're 16 months into this thing. Why isn't the data softening?
How come earnings don't suck when you have inflation?
Would you like me to answer my opinion?
Yeah, let's go.
So it's because the prices of everything have gone up. So we're looking at like nominal earnings growth. That's really not good in reality.
Time out.
Yeah.
I have data. So Savita did this thing. From Bank of America.
Who I used to sit next to for years.
A couple of weeks ago.
Yeah.
So she did this second quarter sales growth. Nominal, it's up 15%. X energy, it's only up 9.5%. But so nominal numbers are still pretty good.
Yeah, because companies have gotten away with price hikes across the board. Consumers are paying them. But that explains why earnings are going up, but consumer sentiment sucks.
Yes.
Like that's the answer
But
to the riddle.
but these prices are not going to come back down. So if inflation does melt away, then these numbers are real.
So here's another reality check. Again, I'm a Minnesota kid, just common sense. I'm in the midst of a 10-day trip. I'm going to Tel Aviv tomorrow night, and I'm going to Paris. I'm going to London, hopefully. Depends upon what happens with some of the current news. But I had to go buy a new bag, right? Because all I have is a backpack and a roller bag. I needed like a duffel bag.
For the paparazzi.
Exactly. And I couldn't believe how many people are shopping on Monday.
Oh, yeah.
I couldn't believe it.
Yeah.
And I looked around and I said, do you really think these people are going to stop shopping? Are they going to stop? All of a sudden stop.
No.
I think consumer sentiment's bad because the media's scaring the shit out of everybody.
And gasoline.
Yeah, and gasoline.
But two things on that. Which consumer is going to stop shopping? The consumer in the bottom the consumer in the bottom quartile of the income or wealth distribution is clearly plagued by high inflation, and we know this from Target and Walmart. Like we know that there's trade downs. They're buying the store brand more than they're buying the premium. Like that we know, but everyone else is really not stopping.
No.
And the guy from Canada Goose, they make like $600 winter jackets, was on CNBC. He's like, there's no slowdown. We're gonna have a great Christmas. Lululemon, all systems go. And then you look at Gap in a full meltdown. So it's like people choose which one of those they want to pay attention to if it aligns with their story.
Correct. The same thing with...
You see that all the time.
All the time. It's like yesterday on CNBC. You start throwing, this company down 24%. You're internalizing it. You're personalizing it. That's why you got to look at everything. All 500 companies in the S&P 500.
Data doesn't work.
No, it doesn't.
Right.
It doesn't. And the reason why they're personalizing, and it goes back to the whole human nature thing in terms of investing, is that they're so afraid of being wrong they don't want to be right. So they default to being fearful until they can't be fearful anymore, and then they proceed on with I got to perform. Is that investing, Josh? And the answer is no, it's not investing.
Yeah, it's posturing. Well, it's one of the most poisonous things you could do to yourself in this game is to wear a uniform. It's to say, no, I'm on the Bull team, or no, I'm on the Bear team, because then every new piece of information that comes out, you're looking at it through the prism of what team you told everybody you play for.
Yeah.
Now, if you're somebody that can be a Bear 1 minute, a Bull the next minute, that's great. I don't think most people are that nimble or should be, because that's a treadmill. So I don't really know what the right answer is, but I think when people have adopted a market view, from then on, once they've said it out loud, no matter what comes next, it's like, well,
especially in public.
Well, I was already right, so here's what I think about this data point, right?
But Brian, so to that point, you've been publicly bullish. What can get you to turn bearish?
Oh, that's a good question. What if the Queen died?
Headlines.
Sorry. All of our English listeners, I don't think it's funny.
Would you have to see earnings start to deteriorate?
Yeah, on a short-term basis, I'd have to see these inflation numbers stick longer than I thought. I would have to see earnings really get crushed on an
unemployment.
Yeah, unemployment.
But here's the thing: if you would have to see the inflation numbers stick longer than you thought, what happens to stocks between now and then? Like in other words, if you say if we're still at an 8 handle on inflation by December, I would say we're in big trouble. Okay. But what happens to stocks between now and then while you're making up your mind? That's like the thing, right?
Yeah, exactly. So and the other thing, too, is that it's a great question, and I'm going to answer it. Sometimes when you're on TV all the time, you kind of don't answer questions, and you're good at it. Anyway. But
I answer the question that I ask myself.
I have not been in a period I don't remember a period in this market for really since early 2000s where everybody was bullish. We haven't been in a period where everybody's bullish. Even 2019, people were not bullish. You still had a couple people out there that were really negative. I want everybody to be bullish. When that's going to happen, I'm out. I think so. Let me kind of go.
As measured by investors' intelligence.
No, all that stuff is bullshit. I worked at Merrill Lynch for a long time.
Say more. I like it. Go on.
It's all bull. You know how you judge people's sentiment? You sit across the table from them and you judge by the kind of questions they ask. I think the worst thing that's happened in the pandemic is we haven't been able to be around our clients and know when they're lying to us. Because people don't fill out sentiments. Who cares? Right. Surveys. Who cares? But so where I'm going with this is I came out in 2010 saying we're in a 20 to 25 year bull market. And I'm not being stubborn. I just still believe that. In 2008, actually, I was still at Merrill Lynch, and I said 2009, we're going to be up double digits. And then 2009, I moved to Oppenheimer because of the merger at Merrill. Moved on. And I said, we're in a bull market. Then I transitioned to a secular bull market. And through all of this, we've been chastised. It's been, you can use whatever thing you want to say. Climbing the wall of worry, blah, 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 most hated bull market. And you can have cyclical bear markets, which we've had 2 of them already in this big secular bull. But I think at the very end of this bull market, so let's say 8 to 10 years from now, we're going to be back into global synchronized growth. We're going to be back into a commodity super cycle. We're going to be back into, there's going to be a hot new product or a hot new market that's not China or something different that we don't know what it is. Maybe it's Malaysia. Maybe it's Zimbabwe came up with some cool drug. Maybe we're going to build a pipeline to Europe. I mean, it's going to be something crazy, or we're going to be able to Star Trek and beam ourselves to
robotics, AI,
something, and everyone's going to be drinking the Kool-Aid, baby. And I'm going to be buying my cabin in Wisconsin, drinking a bottle of Chopin with a bottle of shitty Minnesota beer, smoking cigarettes. I've never smoked a cigarette in my life, and I'm going to be laughing at everybody. I'm going to put everything in fixed income because they're going to tell me, Josh, the magic word, it's different this time. It's different this time. And
you don't think we heard any it's different this time last year?
2021, they weren't saying that? It's different this time for the bulls?
The market structure has permanently changed because of retail enthusiasm for stocks and Bitcoin and crypto and SPACs, and that felt like a euphoric moment to me.
Well,
I don't know.
I call that the 4 horsemen of the apocalypse.
Okay,
right?
Which is what?
So Kathy Woodstock's lover. Okay. Longtime former client.
Yeah.
Okay. Kathy Woodstock's.
Yeah.
SPACs.
Nothing personal.
Nothing
just
personal.
A strategy.
It's just a strategy.
Yeah.
The meme stocks. The SPACs.
Crypto.
And my favorite crypto.
Right.
Right.
Yeah.
So the market did a good job taking those out. And then they took out the high multiples, and then they took out the high growth. Then they took out the generals, and then they took out energy, right? Was that May, June?
Yeah.
That's when I felt with some accordance that this is the bottom.
And energy 100% down on multiple compression only. Nothing fundamentally changed.
Nothing fundamentally changed.
Only got better.
And so, is it different this time? So why do you have to go back and say everybody was saying capitulation? Do you need capitulation? No, you don't.
I don't think so.
No, you don't need capitulation in a market like this. And I have always not said it's different this time. But what I will say is that we investors or society have to give ourselves a break. What we've been through the last couple of years it's unbelievable.
Yeah.
It's unbelievable.
But stocks have done well, though.
Well, it's because of the free money.
I'm so with you on this concept. In Game of Thrones, we're a reek. Do you watch Game of Thrones? Nobody in this fucking room ever watched this. No idea what I'm talking about?
I watch House of the Dragon.
All right, so literally, there's a character in the show who's a prince, Theon, and he ends up, I don't know what the scientific term is, but they remove his manhood. And then they put him in a cage and raise him like a dog. And they beat the shit out of him every day.
They cut off his Johnson?
They literally, it's one of the most brutal things that happened in the whole 10 seasons. And he gets to a point where he's just so used to being beaten up and horrific things happening to him that when they come to rescue him, he fights back. He's like, no, I want to stay here. This is what I am now. This is what I deserve. And they're like, well, okay. They went back to the boats. I think, speaking of my generation, we start off with the dot-com crash. We watch our parents bankrupt themselves, basically.
Yep.
Right after WorldCom, Enron, 9/11. Then we have a 4-year bull market. Boom, housing crisis. 2 S&P cut in halves in the span of 7 years. It's almost like we don't deserve to just have a secular. So when this secular bull market started in 2013, it was really hard for people to feel good about it.
Yeah, because think about what you just said. In the 2000s, the market strength in equities had nothing to do with U.S. stocks. It nothing. It was all about emerging markets and decoupling and all that bullshit, right? Yeah. But it was really, whether or not you believe me, it was 2009, 10 or 2013, whatever.
Well, I'm going by taking out the previous cycles. So, by the way, 17,000 on the Dow in 2000, right? Mm-hmm. And then again in 2007. So when you broke that and the S&P broke its old high, like that's how we don't date the start of a secular bull market from the bear market low.
No.
So 09, yes, we had a rally off of 09.
I agree with you, but here's the weird counterpoint. A bear market starts at the top.
What do you mean?
A bear market doesn't start. You measure a bear market from the top. So ipso facto, you should measure a bull market from the bottom.
Yeah, but we don't.
But we do.
Secular.
Oh, okay.
We say 1982 to 2000 is a secular bull market. We don't start it in 74. You know what I'm saying? Does that make sense to you?
Yep.
Okay.
Yep.
When do we say the post World War II bull market started? Not in 1933, 1945. So that's how I'm saying. So 2013, you take out the prior cycle's high and keep going.
Yep.
I look at that and I say, this feels like a new secular bull market, but I'm afraid to say it out loud. I have a blog post about it. I don't want to be the asshole that jinxes it for everyone by saying new secular bull market, but that's what it was, in hindsight.
I could be your Doug on that.
Yeah, okay.
Can we talk about this? So Josh and I were speaking the other day that all of the negative return from the market this year is from multiple compression because earnings are still up. So multiples are squished 20%. And we were saying, how much do earnings fall, generally speaking, in a recession? And a day later, I read your post. Brian wrote, median peak to trough decline in S&P 500, LTM, what's that, last 12 months?
Yep.
EPS during a recession is 18%. We haven't seen any real downtick this year as the number is over 5%. So what's going on here? Normally, it's 18% decline. Here, there we go. Josh, look at that. 18% decline in earnings.
But we're not in a recession.
I understand that.
Yeah.
So why would you expect to see that?
Bingo. Yeah.
What's up?
That's what I'm talking about. So that means just do the math, then we get 23. Now we need a 23% pullback to just kind of get back into the median, whatever. It's not going to happen. Can you think of another multiple compression period like this that didn't coincide or lead up to a recession? You can't, right? No, but yeah, I keep going back to like 1990. And you know what's really funny? You should get an economist on here and ask them what kind of recession we're going to have.
We do that every week.
So there's three types, the three C's of recessions, right? So the consumer recession, credit recession, CapEx recession, right? So which one is it going to be?
CapEx.
Well, you think we haven't had any CapEx? How can we have a recession? Right? So
also
they'll say consumer because they'll default to the consumer.
Also, like enterprise spending is the new CapEx, it's not going
Brian,
anywhere.
what if the reason why things haven't softened is because there was so much pent up demand from people waiting to get out, and everybody was going to travel, and everybody had stimulus money, and we're now working our way through it?
Yeah, the U.S. consumer, never bet against the U.S. consumer, right? We're just in it. That goes back to the statement I said before. Are we going to stop spending money all of a sudden?
Nope.
I mean, it's like crack, right? Or it's like when you have one Skittle. You can't just have one Skittle. You're going to have like 45 of them, right? So I think it's going to be stronger than everybody thinks. I think the earnings probably going to go down. My earnings number's too high. Shocker, right?
For what, 23?
22. I don't do a 23 until November.
What's your 22 number?
245. And you go, holy shit, you're nuts. But
where's the rest of the street at? Like 210?
220, something like that. 225. Right now, and we have the chart in the report. I think numbers are at 227, and they're down from for 20. They're trending 227. I'm sorry, down from 230. Whoopity doo.
Yeah.
Right. What's going on?
Yeah.
Well, people are bearish. You said like nobody's positioned for this. Sentiment Trader, I don't know if you ever read his stuff, but this is
John,
a chart.
Can you put this one up?
Yeah. This is a chart of institutional net speculative option premium. And this almost looks fake,
That's crazy.
Last week's panic hedging was 3 times more extreme than in 2008. What the?
That's just because there's more people trading options now than
people
then.
are so bared up.
Do you agree with that? Like
100%.
It's just an options circus.
Nobody's
going on.
mentally, or I don't know about financially. Nobody's mentally positioned for a year-end melt up.
Nope.
Because look at the corollary from late 21 where nobody was long enough. It looks like a mirror. It looks like a mirror image. It's a spike higher and then a spike lower. I think it's retail options trading. Right?
No. That's too big.
hedging?
That's too big. Look at that money. That can't be retail. No way. They also say it says institutional trader.
The last 2 or 3 years, there's
that's in billions.
Yeah.
Proliferation of multi-asset strategies and building out that product across every major money manager and every major brokerage firm in the U.S. So that's what that is. Has to be.
So what are they doing? Like the market breaks a moving average and they just start like selling calls or buying puts?
It's all rage against the machine.
You could also say that the market's acting a little bit better. John, throw up this next chart, please. So we had a pretty nice rally off the lows from June to the middle of August. When we bottomed out in June, 40% of the market, of the S&P 500, made a new 52-week low. So almost 1 in 2 stocks. On the recent pullback, now granted, we were like 6 or 7% higher, but almost no stocks made a new 52-week low. Like 5% of S&P 500 stocks made a 52-week low.
That's really interesting. So the internals on this last dip lower were much better.
Much better.
Right.
So many people don't know this, but I started my career at William O'Neill & Company, an investor's
Oh, no way.
Really?
Yeah.
Okay.
And so I had the amazing opportunity to have this great mentor, William O'Neill, but then because he's Bill O'Neill, a lot of cool people would come by, like Charles Schwab and Peter Lynch and Warren Buffett. I had exposure to these guys. Like I'm like 23 or 24-year-old punk. And I look at this chart as a former chartist. I started my official sell-side career after that at a place called Dane Bosworth as a technical analyst. And that looks to me like the semblance of a cup with a handle chart. Just like if you take a look at what happened in 2020, April, and then we had the cup, the handle, and then broke out. That's a huge breakout. And then it looks like this pullback here again, April, May, June, is a bit of a cup. And now the handle's a little bit more extended, but it looks like a cup of the handle.
It's like a saucer. It's like a saucer.
Which I learned that you have the saucer and you have the handle, right? That's really bullish from right here.
People laugh at pattern analysis, but like the cup and handle, the psychology behind why that makes sense, to me is so intuitive. You get this dip, and then it falls off, but it falls off much less so, and then resumes and gets back to where it originally fell off from. And the people that didn't buy the dip are now scrambling as prices make new highs. That seems like a very intuitive psychological thing that investors do to themselves all the time. So that's why I think like some kind of pattern analysis makes sense. I hope this resolves that way.
No, I think so. And it also kind of follows through the theme of our report, Hold the Line. I was not thinking about technical analysis when I wrote this, but I mean, clearly you want to know, if you're an old technical term, you don't want to be catching a falling anvil, right? And that's what 2020 was, the falling anvil. I mean, that was probably one of the best capitulations I've seen in my career.
So if we get into third quarter earnings, like 2 weeks in, if we get 2 weeks in, we will have heard from the large banks, and I think a couple of retailers.
You'll see some tech too.
Okay, so if we get through that portion of earnings season, and there's just not this apparent deterioration or meltdown, that could start the performance chase.
I'd
into new highs.
I feel like I'd be ready to call it in Q3 if earnings don't soften. They're not going to.
Correct.
What do you think about that?
I think that's true, but I still think people are so stuck on inflation. That number's got to start coming down.
That's got to be part of the equation.
That's got to be part of it.
Okay.
That's got to be part of it.
Can we talk about the case for so the case for a soft landing? Is this Hatius?
So Jan Hatius spoke to the Journal, and he made a few key points. He just said basically, forget history. History is not a guide for the current environment, so just throw all of this out the window. He said inflation expectations and break-evens are coming down. A cooling labor market should manifest itself as lower vacancies and wage growth and not necessarily higher unemployment. So I want to look at a chart that you put in your report, Brian, showing that for every recession, unemployment was never below 5.5%. But normally it's way above that. Right now, we just got what are the recent numbers? Are we still under 4?
Oh, you're showing where the unemployment rate at recession end is?
Yeah.
So tell us what you're telling us here.
I'm telling you.
Tell us what you're telling us.
Show me what you're showing. It's going to be really difficult. Let's just keep the math simple. It's going to be really difficult to get to that 5.5% from here.
Is that because there's so many job openings, or what exactly?
Well, people are There's job openings. There's non-job seekers. There's the underemployed, and I mean, let's call it what it is. 2021 is a good year for financial services, right? I mean, but 2022 is a different year, and we're spending money. We're going out with clients. It's not going to be as good a year. But so those wages are going to come down a little bit, but then the bottom end is going to come up. So I don't really see this whole notion of massive wage issues. But to get above 5, we need to see almost a percent
to get above 5% unemployment.
Unemployment, yeah. We need to see massive job losses.
Where would those even come? I'm trying to think, like, where would those even? They're not coming from hospitality, clearly. They're not coming from maybe is technology the source of. Is that what everyone's worried about when Netflix does a layoff?
No, because you hear Apple, Microsoft slowing their hiring.
Right. It's like, where would those job losses even come from?
They'll just go somewhere else in tech.
Absent a crisis.
Right. They'll just go somewhere else in tech.
Yeah.
But you're right in the hospitality side. I mean, they still don't have enough workers there.
Maybe never will.
Maybe never will.
Right.
But going back to the premise of we're going back to work, right? So from 3 to 5 days eventually, and this is going to be a process in the next couple of years, that's going to force people to get off their couches and stop playing Call of Duty and trying to trade stocks, and that phase is over, I believe.
You don't think that a lot of companies have just adopted a permanent hybrid or work from home policy, especially gigantic companies like in technology? Like if companies like Alphabet that, I don't know, what do they have, 100,000 employees or something? They're not telling people to come back in. Goldman Sachs is. But there are some big employers that are just they're good with how it is.
The banks are, but like now you're talking about human nature, and these companies are covering their ass because they don't want to get sued.
Right.
And you're telling me I have to be in the office 5 days a week? Oh,
Yeah.
I have anxiety about the vid and the cron and everything else. I got to wear a mask, and so we have to. That's going to take a while to unwind.
I think that shit has to end immediately, but
it has to end.
It's just, but it's not going to.
I don't think it's happening. I don't think it's going to happen. I don't think 5 days a week is going to be a thing ever again.
Yeah, I really don't.
I don't.
Look how well we handled.
Of course,
0 days in. So why go back to 5? I mean, I'm all for it if companies want to do it, but
I don't know about you guys, but I'm massively efficient working at home.
Yeah.
Way more efficient.
Yeah, I'm inefficient both places. So so it doesn't really help me one way or the other. All right, but do you agree with this take, though? History is not a good guide to the present. There's just too much unprecedented shit going on.
We turned the economy off for a year.
Well,
and then we hit it with $10 trillion.
You talked about it earlier.
What precedence is there for this?
You tried to get me to say it's different this time?
No, I didn't.
It is.
Well,
it's unprecedented. Think about this is why we have to cut ourselves some slack here.
I say it's different every time.
We've never seen this before, man. And think about how strong we were as a country, number one, but also as a human race, and how hard we pivoted, man, to do what we needed to do in terms of keeping our society open and our business open as well. It was amazing. So, no, I do think it's unprecedented. And that's why I think more and more that I think it's going to be a couple more months before people start to figure out. And it's probably going to be earnings, but more than anything, maybe a dip in inflation to say, we're not going to the end of the world.
Instances of inflation above 5% back to 1946. 0 examples of that inflation being cured by anything other than a recession. Every single time the recession has cured it. Soft landings. Here, this is the Journal. The main obstacle to a soft landing is the historical record. In the 3 soft landings since World War II, 1965, 1984, 1994, the Fed wasn't trying to push inflation down. It was trying to keep it from going higher. At times like the present, when inflation was too high and the Fed set out to push it lower, a recession always occurred. Hatzia says that's too small a sample size and it's mostly the 70s and 80s. What do you say to that?
It is mostly the 70s, 80s. I remember I was an analyst in 1994, and I saw what was going on there. And then when the Fed made the pivot in 95, that really started the Nifty 50.
Yeah.
And then
Crazy rally.
Crazy. It was nuts.
Yeah.
And then tech. But tech really didn't come on until 96, 97. Really, 97 is when it really got going.
The internet IPOs were all in 97.
Yeah.
Qualcomm, I think.
Yeah. So I think the 70s and 80s probably are better. But at the end of the day, if you take a look at, I mean, it's so dangerous not to say it's different this time. You take a look at the construct of earnings in our country and in the market are much different now.
Oh, yeah.
Than they were in the 70s and 80s, much different. And if you go back into the 40s or the 30s, right, people forget that our country's economy in the 1930s was primarily agricultural. You know, the notion of the Dust Bowl was because we had this period of higher temperatures and the farmers lost all their money, and plus there was no money to go around to feed people. The fields dried up. That was a Dust Bowl because the majority of our business in the United States was agricultural. Still was. It wasn't until World War II that we became massive industrial, and then we became obviously the great consumer nation in the 40s and 50s. And
Michael and I have been fighting that battle on the blogs for like a decade, like the Cape ratio shit.
Oh.
What the f*** are you comparing us to? Like you're comparing us to a steel mill economy? That's the multiple that you think the modern U.S. economy should have? Is we at the bottom at 8 times 10 years worth of earnings? It's almost absurd, but that's still out there. That's still a thing. Like we haven't washed out enough on 1 year, on 10 year. I don't know. Maybe, so between 16 and 18, that's where we are now. That's enough?
Yeah, I think so.
We've been through enough.
I think we've been through
16
enough.
and 18 PE, trailing 12 months. It's like enough.
I think we've been through enough. And then just going back to what I said before in terms of, you know, where's the money going to come from? Well, it's going to come from some FOMO, but I think it also is going to come from non-U.S. investors coming back here.
Okay, I like that idea. Who's like who? The Europeans will have no money if you listen to recent news reports. They will spend all of their money on electricity.
Well, they still have to invest, right? They're still investing.
The Chinese are buying Canadian real estate as a safe deposit box.
They're buying Western Canadian real estate. But the cool thing about Canadians and being up there now for 10 years in terms of covering that market is the best contrarian market ever because in just this last couple of months, they've had the biggest outflows in Canada since 2017. And then after that, 2018, 2019, great years for the Canadian market. Everybody in Canada is scared shitless about the banks. And so what are the banks doing? Now they're starting to become more conservative again. That's when you buy the banks in Canada because they're excellent stewards of capital in Canada, amazing managers in terms of cash flow and dividends. And so I think Canada's coming along for the ride, but unfortunately they have some other issues in terms of politics and things like that up there. But there's so many great.
We don't have those here.
We have no issues politics here. But I think money's coming back.
Are the things that are falling now enough to take inflation down to where the Fed will feel comfortable not doing 75 basis points every time? Like what we have this freight cost chart.
So the cost to ship a 40-foot container from China to the U.S. West Coast now stands around $5,400 a box, down 60% from January.
What's this? I mean, it's
the crude oil is down a lot from its high. Gasoline is down a lot from its high. Housing is coming down, which might present another challenge. But it looks like inflation has peaked.
That's been our call, and from the housing perspective, though, we still need massive supply, so prices are probably going to go lower as we add more supply.
But how psychologically important is the housing market to consumer spending, to the stock market overall? That you have this housing affordability index, the year-over-year change. It's the worst we've seen going back to 1972.
Could you make that chart smaller? Is there any way?
Here we go.
Oh, here we go.
Sorry about that, Brian.
He showed you a postage stamp.
Not my contact.
So what is this? National Association of Realtors Housing Affordability Index.
It's a year-over-year change.
Well, if prices have fallen 6 months in a row, this will get more affordable.
Given that the 30-year mortgages went from 3.3% up to 6%, and the median house went from whatever $240 to $370 or whatever it is. Yeah, housing got a lot less affordable. And doesn't that have a big impact on consumer psychology, spending, all that sort of stuff?
It does, but look at remember 2008 where people are just handing their keys over, and they'd rather hand their key over to their mortgage and still go to Costco to buy 10 cases of Diet Mountain Dew and some water, right? So the consumer still, we're
Diet
weird.
Mountain Dew.
Yeah, of course.
Well,
Why would you drink Diet Mountain?
That's not a great comp, I guess. Next Tuesday, the 13th, we're going to get the next CPI print. This feels like the market event of the year. The debate over 50 versus 75 is over
75.
because
It's 75.
yeah, Nick Timiraeus
Adrian-
printed it yesterday before the bell, so that's it.
The new Woj. He's the Woj of the financial sector.
Right. So 75 basis points. Then we're gonna get an unemployment number, and then the Fed's gonna have its meeting. Or we got the jobless claims. We'll get the inflation, and then the Fed will have its meeting.
Brian, what do you think?
What do we do from there?
Wait, hang on. What do you think about? Sorry, I don't know why I just hang on.
Gotta love it.
What do you think about this idea that at some point, if we're not there yet, fixed income will be a viable alternative for equities? Like, at what yield do people say, you know what? I don't really want to pay 15 times 60. I don't really want this stock. I'll just take some bonds.
I love to answer that question with think of the person that bought a 10-year treasury at 10 basis points in March of 2020.
That's crazy.
How are they feeling?
Yeah.
What's that real rate of return?
Might as well have bought an ARC.
Negative 15.
Exactly. I mean, think about this. People give me shit for talking about secular bull market in equities. We've had a 40-year bull market in bonds. How come people aren't talking about that? The unwind of the 40-year bull market is happening before our very eyes. I think you can have tactical trades in fixed income. Now, whether or not that's at 4%, or when you start buying it again, because then you'll see some appreciation. But the majority of returns that people have received from fixed income is because of performance, not because of yield. It's a fallacy. It's a complete fallacy in terms of the whole balanced portfolio thing. So is there a magic number? I don't know. Maybe it is 4%. I don't know what it is. But again, as part of this whole transition back to normalcy, I think that we're going to return to normalized returns, normalized earnings growth, normalized fixed income or 10-year treasury, somewhere between 3 and 4%. Maybe it's 4 or 5%. I don't know what it is, but it's going to be some sort of a tight range. So what the Fed does here in near term, I think you're either on something or onto something.
Both.
Thank you. You like my joke. I think next week's a seminal week.
Yeah. So if we have a 75 point, well, so here's the point I wanted to ask you about. So yesterday before the bell, Timiraeus publishes. He says the Fed is leaning towards 75. So it's a done deal. Stock market Dow goes up 450 points. Nasdaq outperforms. Nasdaq goes up 2%. What does that tell you about how the market will probably now handle a good inflation? What's a good inflation print? 7, 9, 8,
Dude.
8? Oh, I don't know.
Just give me some derivative in the other direction. Just give me any direction down.
Even a lack of acceleration is like good enough.
Correct.
Okay. All right. So how does this market react to a 7-handle inflation print for the month of August?
What if it's 8.5? What if it picks up again? That would be very bad.
I mean, based on how they calculated, it definitely could.
It could. Likelihood is low, very low. But then maybe that's the low.
Okay. You think we revisit the June low?
No,
Okay.
I mean, not that low.
Okay.
No, not fire and ice.
So in either case, barring like an alien invasion, this is the inflation print you buy.
Correct.
Okay. And then we get the 75 basis point. They've already done 2 of those. So you get the third. And now we're all going to debate 50 or 25 at the next meeting, right? Or do they go into January or do they end it this year? Like whatever that debate is. And then the other thing that's lingering out there is the increasing pace of quantitative tightening. Do you not care? It's hard to get you excited about that one.
No, I can't get excited.
Okay, why?
They should be doing it.
Yeah, well, they should have been doing it 9 months ago.
Correct.
When housing was up 40% over 2 years, that would be the time to.
We were very critical of the Fed in 2021, just like we were critical of the Fed in 2012, 13, and 14. I mean, stop this. Enough's enough.
Yeah.
But let's go back to it. Strategists invest and economists are late. So the economists were late. They were completely wrong in their forecasts. The Fed was late. Why? Because they're a bunch of economists and they're looking backward. So we talked a lot about unemployment.
Dude, can I ask you about that? They have 400 PhDs in that fucking building, and they were buying mortgage bonds 6 months ago. What is going on there? What do they think? What was the thinking? What was the thinking behind 0% interest rate policy with the stock market at record highs,
housing
home
up 30%.
prices at record highs, and unemployment on its way to zero? What do you
How
think?
could it get any better than that?
What do you think they were thinking? I guess is what I'd be curious.
I don't
to.
even want to pretend to even imagine how an economist thinks.
Yeah,
I just don't get it. I don't. I've never gotten it, and I've taken a lot of shit for it over the years by giving economists crap, and I'm probably going to get to after this, but. It just falls back in my thing about academic. We're so afraid to be. Do you remember the bullshit in February, March of 2020? It's going to be the Great Depression.
Well,
GDP is going to go down
I'm part of that.
40%.
Yeah,
I'm like, this is egregious,
Yeah.
But no, I don't. The answer to your question, I don't know. Now you asked me about when I should be bearish, right? Shoulda, coulda, woulda. When that shit was going on, I should have pulled the plug. I should have actually pulled the plug.
What do you mean pulled the plug?
Pulled the plug and said, this is going to be a rough patch for the next year when we were seeing that silliness. I probably should have. But the problem with that is because I also run money. When you sit across the table from someone, you say, sell, they're not coming back. They are not coming back.
That's why we say underweight.
Yes.
Yeah.
You talked about utilities.
That's a really great point. You can't tell somebody the game over.
Yep, they won't come back.
It's not investment advice anyway. It's childish. It's not the people that are doing that on social media, whatever, don't manage any money. They manage newsletter subscriptions.
Correct.
Right.
Or strategists that come out and say sell. They've never sat across the table from a
They
client.
laughed out of the room.
Yeah, and I've lost money for clients, and it's excessively humbling. And you have to kind of go through that. And this has been a humbling year for me to be bullish. But at the end of the day, I have my convictions and I believe what I believe. And oh, by the way, every time I'm on Halftime Report, right?
Don't take this up with me.
No.
And another thing.
And they grill me.
God, good say it.
And they grill me. I actually get AUM.
Part of the show, dude.
I get AUM, and I talked to Wapner about it. I said, thank you. And he goes, why? Because I love it when you grill me because people give me more money.
Of course, because it forces your conviction to come out, and people watching television respond to people with conviction. And Wapner is the best. I think he's the best host. I mean, I've seen for 20 years every host on every financial show, other than Rukeyser, different era. I really think Wapner's the best because...
I was on Rukeyser.
Were you?
Yes.
What were you, 14 years old?
Again, I was 12 years old.
Were you a page?
I was scared shitless.
What'd you say to Rukeyser?
I was
Buy him.
No. No, actually, it was December of 2020, and I had just went to an underweight in tech, and he was giving me shit. And Rubini was on.
When was this?
December of 2020.
Louis Rukeyser? He's not with us.
No, 2000.
Oh, okay. All right.
Sorry. I had
I was gonna say, you might have imagined this.
Senior moment.
You might have imagined this episode, Brian.
Who's the guy? Laszlo Barini was on.
Oh,
He's like, Belski, why are you so bearish? The market's going up. It's like, no, it's not.
Yeah.
And I was so scared backstage. I was like shaking. I remember that Friday night in Owings Mills, Maryland.
Is that where they taped it?
Yeah.
Yeah, none of this Skype shit either.
No, none of the Skype shit, man. You had to go there. I remember.
All right, so you were saying Scott's the best, but what were you saying?
Well, I was making the point that
yeah.
Scott will force the conviction out of a guest so that they actually say something meaningful for the audience.
But
he
Haynes
does that
did
really
too.
well.
Haynes did too.
Haynes did it too. That's
Haynes
right.
did it too.
Shout to the judge.
Yep.
All right. So if you feel like just to kind of button this up and then we'll move on.
Yeah.
But so you agree with me? Whatever comes out next Tuesday, the 13th. That's really going to be meaningful for psychology, for positioning. Like people are going to have to say, do I really want to stick with this recession shit now or this bearish point of view, or do I want to rethink that?
So I said earlier about it's all about inflation, right? But do you know what's going to come out? Well, earnings still might suck. You're still going to see that. That's going to be the narrative.
It also might still be true.
Of the bearish narcissists that they create.
Oh, man.
They're nihilists.
You're in for it. You're in for it. Did you have fun today on the show?
I did. It was amazing. I wanted it to be sooner when I got the invite, but God's got a plan, and this is all part of me being here.
Awesome.
Timing is amazing.
So, all right. So, I think your research is great, and I think you have a really great way of delivering it. Absolutely love it. I know you don't write publicly because you write research for the bank, but is there a place that you have ever considered doing something a little bit more publicly, like a Substack or LinkedIn? Like, do you have any interest at all in like putting stuff out for everyone else, or not really?
It's a great question. We do
you've thought about it, right?
Yeah, of course.
You're a good writer.
Thank you. We do publish. We do put up. We're allowed to put up 2 media links every week on LinkedIn.
All right. Well, listen, it's better than none.
So we're putting yours up.
Okay.
So
right.
Thank you very much.
Awesome.
And so no, we're humbled to be here. But no, listen. When you write for so long, and I have a great opportunity to travel around the world and talk to people. If you have conviction in how you present, you should be able to write. And if you're able to write, you should be able to present that. Period. I remember when I was interviewing for a big sell-side job in 2002 here in New York, and they told me, "You come work for us, you'll never write again." I said, "Guess what? I'm not taking the job."
Yeah. How do you know what you think if you're not forced to commit it to paper? I feel like that's an integral part of investing, is being able to communicate why you feel a certain way.
Absolutely. And I think, I've used the word humble a couple times, and I've been humbled several times in my career. I've lost my job 3 times, and it's amazingly. I didn't know the first time. I knew number 2 and number 3 that were coming, but it's amazingly humbled. And I think this job is it's the coolest job in the world. Coolest job in the world, and it makes me, because everything changes every day. I love managing chaos. I love it, and I love fixing things. I'm a truth seeker. I love to figure stuff out, and I've done that my entire life, and it's served me well to have this job. And I would never want to be, I've been offered to be like an industry analyst early in my career. I'm like, why would I just want to cover 20 stocks where I can cover the entire market? And so that's what I based my entire career on. But more than anything, I love being right, baby. I love being right.
I hope you are right.
I love being right. But I love also seeing people's faces on when I make them money or explain stocks. I mean, I come from a different generation of strategists. I don't think strategists nowadays know how to tell stories. They know how to tell stories and themes on why you buy things. And because
they get mocked for it. Because quant is sexy now.
But the bears are sexy. They're so eloquent, and they can have all these great charts and this analysis. And bears are smart, but bulls make you money.
By the way, they're usually British and Canadian, the permabears, and I found that as well.
So I saw David Rosenberg, my very good friend and former colleague at Merrill, and I was having a beer with a broker.
When did you guys work at Merrill? Was Rich?
Rich was my boss.
Okay, so is Rich Bernstein, you, and Rosenberg all at Merrill at the same time?
Correct.
That's crazy.
Oh, it was. That's why you asked me earlier. What was my best?
What era? Tell me that era. What era?
2005 to 2009.
It's like 3 of the smartest people that have ever worked at Merrill. And you guys were all there at the same time.
It was amazing, and to be at the table with all these people.
And Savita was somewhere too.
Savita sat next to me on one side, Marianne Bartels on the other.
Wow. She was the technician. Yep. Now she's the strategist.
Yeah,
okay.
Yeah. She was the technician, but the coolest thing about Merrill was you always had to be on. You didn't know what question was coming your way, and it was an amazing experience. So, a couple of weeks ago, I was in Toronto having a beer with a broker. And I said, watch this. Rosenberg's sitting over there. So I go over to Rosie from behind and I give him a big bear hug and I kiss him on the cheek and I go, "Hey, Rosie, baby." He starts screaming, "It's got to be Belski."
Yeah.
Like we're so diametrically opposed.
I was going to say, you guys are like he's like the bizarro version of you, or you're the bizarro version of him. Like you're complete opposite.
But there's mutual respect, because I would never be able to spew out macro data like this man. The man is prolific, and he would never be able to talk about the thematic reason why I want to own Apple or Netflix, or why I like the big banks versus he can't do that, and he respects that, and he lets me do my thing.
Right. So that must have been quite a time. And Rich was the boss.
Rich was the chief investment strategist.
Yeah.
I did U.S. and sectors. Savita was quant.
Okay.
It was an amazing time.
I'm a big fan of Rich's stuff. I get his stuff once a month. It's like always very refreshing. He's still at it. He's still doing what he does.
Yeah, I mean, it's easy too, because you have that passion. You love your job.
Yeah.
And he's done a good job kind of morphing into the money management thing. And he's had such a following in the retail side, as I did as well. And Rich kind of really allowed me to do what I did.
You know what I noticed? I'm glad you said that. Like when you bump into former Merrill people, they still worship the strategist that was there when they were there, because that was the story they told to their client every month. Well, they would say, "Well, let me tell you what Belski's saying," and like they continue on and follow that person's work no matter what bank they end up going to. Do you find that?
Very much so. I was there 4 years, and I'm still Brian from Merrill.
Yeah.
And people still remember me from Merrill
But
Lynch.
that's cool because
It's super cool.
Because Mother Merrill is always going to be, even though they killed the brand,
Yeah.
which I still will never understand to this day, but that's still a little bit of a badge of honor on the retail financial advisor side.
Yesterday
I
afternoon,
worked at Merrill.
I got 15 emails from Merrill Lynch brokers.
Yeah, they remember you.
Yeah, from just
And they have your back to this day.
of course they do.
Yeah. Just don't up your earnings estimate here.
What?
Well, listen, you held your own, and you always do, and certainly on this show as well. This is the part where we're going to do favorites, and then we're going to let you get out of here and go to Tel Aviv or whatever you're doing. Michael, you're up first.
Our friend Kai Wu, who's been on the show before, did a post. What did he call it? He called it liquid venture capital, where he reconstructed a venture capital portfolio using publicly traded companies. And he did a killer job. I'm just going to this one chart.
Wait, what does that mean?
I'll show you.
Okay.
Is the chart going to be like a stamp size
No.
again?
Look at this.
Yeah,
Look at
enlarge
this.
it.
So the red line is Cambridge Associates U.S. Venture Capital Index, and the green line is what he was able to replicate using publicly traded stocks. Pretty wild, right?
Yeah, how?
Using patent data and market cap and earnings growth and all that sort of stuff. But the thing that I thought was so interesting in this post is the following. Of the 1,495 U.S. venture deals in the first half of the year, only 4.9% have been a down round. Look at that. No down rounds yet in venture capital.
How is that possible?
They're just not doing it.
Or they're not reporting it?
No. They're
like, here, just take this money and we'll put out a press release later.
These are of the rounds that have been reported. Only 4.9 have been down, which is a historic low.
Wow.
So
I would have thought that would be so much worse by now.
Not yet. It's coming.
It's got to be coming. There's no SPACs to take these things.
Unless it's a secular bull market. Anyway, read that piece from Kai. It was excellent. Sparkline Capital.
What do you got for favorites? Book, movie, TV show, piece of research, podcast. What are you into these days?
Everybody always asks me what my favorite investment book is.
Yeah, that's what we want.
Has nothing to do with investing.
Okay, great.
It's called The Art of Contrary Thinking. It was written by Humphrey Neal, and it talks.
You never read that? Okay.
And it talks about thinking differently, and I based my entire career on that.
When was it written?
I think in the 1920s or 30s.
Still relevant?
Yes.
More relevant than ever.
More relevant than ever. That's why I love to pick on consensus. If everybody says this color bottle's blue and they believe it, it's actually really green.
Isn't the consensus sometimes right? Or is it good to be contrary all the time? Does that always serve your interests?
So great question. It's always right to be contrarian if you have the analysis to back it up.
Okay.
If you don't, then it's wrong.
Okay.
You know, like focusing only on the Cape Shiller.
Yeah, no,
that's
not
contrarian.
Me. You won't catch me doing that.
Oh, by the way, it's wrong though, right? You can be contrarian and believe that, or you can be like SocGen, who's always bearish.
You see Grantham, Super Bubble.
Oh my God.
And Barron's puts it on the cover. They love it. Barron's, I think, calls him and says, please just say some crazy shit. Please.
Every time that happens.
We don't have a feature story this week.
Every time that happens.
How many people send it to you?
300-400.
But you can't dislike Grantham because he's so eloquent.
We need him.
And we need him.
I need him.
Okay.
He completes me.
What if he's right? No, I'm just kidding. All right. I want to talk about the Howard Stern show came back from summer break, and his dad died this summer. And he spent the whole show. And like for Stern listeners, Michael's like a Howard Stern super fan. He's been mocking his dad and his dad's voice and his mom for, 40 years on the radio. But he like really spent like 2 hours or so like picking apart, not in a good way, like dissecting his relationship with his dad. And they were not like really close, but they were really close. And this whole story where his dad had a glass eye his entire life and never talked about it once, like never once complained about it, never referenced it. Nobody around him would ever reference it. It was just like one of those things that people from that generation stubbornly lived with, and you would never hear a word about it. And I just thought that whole anecdote was insane. But I just thought like the way that was handled on the air, like Howard Stern being very serious, and I thought it was like beautiful kind of. So I almost called my dad after. I didn't, but anyway, if you have the XM Sirius app and you're a subscriber, you could find that episode. It's from Tuesday of this week. It was Tuesday's show. All right, that's all I have. What are we doing at the end of this today? Anything? It's Future Proof is 4 days away. Are you like
Duncan? You've been awfully quiet.
We'll be doing a live show
Well, what are we doing though? We're doing live Compound and Friends show
and Animal Spirits.
and Animal Spirits.
Wait,
All right.
is our show with Cheryl going to be up on Friday?
That's the plan.
Yeah.
That's the plan.
So it's not live, but Animal Spirits you are doing live.
No. We are doing it live.
No, I mean, so it's live like an album is live.
Okay.
You know what I mean?
But you can't actually do a live podcast. You have to actually hit publish on it once it's recorded.
Right.
Yeah, but we're saying the same thing.
Yeah.
Live to tape.
We're doing it live in front of an audience.
Live to tape
We're
is-
doing it
is
live
the-
in front of an
Live
audience.
tape. Do you have a guest for Animal Spirits or it's just you and Ben?
That's just me and Ben.
Okay, so you're doing that what day? Great.
Tuesday?
I believe it's Tuesday.
When are we doing the Compound and Friends? Also Tuesday?
Later in the day. Yeah.
Michael's doing 8 podcasts on Tuesday. Anyway,
Michael got me a Tropical Bros shirt.
I saw. We're going to have a great time at Future Proof. For those of you that are going, congratulations. You're going to be at the biggest wealth management event of all time. And can't wait to see you there. If you're not going, no FOMO. We'll be recording all our shows. We have great guests. We're gonna have a lot of fun, and you guys will get to watch it on YouTube, listen on the podcast. So look for that. Thank you so much to Brian Belski. This was so much fun. We could have done hours with you, dude. Like, we got to have you come back.
I would love it.
What are you doing tomorrow? Too soon?
Too soon.
Can we? No, but all kidding aside, can we have you back in December so we can see how accurate you were, or if not,
I would love it.
What might have gone wrong? We could do that.
I would love it. Yep.
We would love to have you back then.
Hold the feet to the fire.
All right, Nicole will email you eventually. We'll set that up. All right, you're the man. You
Thanks
did a great
so much,
job
man.
today.
I appreciate it.
Thank you.
We appreciate it. Compound and Friends. We will see you guys next week. Thanks for listening.